Hey guys, so let me ask you something. How many of you are trading with a previous day high and low added on your charts? My guess is that only a small minority of you are paying attention to these levels. If you add the high and the low of the previous day on your charts, you can see that the market is often reacting to these resistance and support levels. These two lines, the previous day high and low, represent one of the most important levels for today's price action. In this video, I'm going to show you an easy intraday trading strategy that will help you to enter the market around areas of strong support or resistance with narrow stop losses and excellent profit targets. This strategy is mainly based on finding confluence around previous day's highs and lows. The previous day highs and lows are one of the most common and reliable support and resistance levels. They work because they are visible without traders having to use any particular indicators. They are obvious to everyone looking at the price chart, and these levels work because the masses of people trading the market respond to them on a daily basis. The beauty of these levels is the fact that you can use them both in trending and ranging markets. In an uptrend, you will often see that the previous day high will serve as a strong support for the current day, as you can see on this Apple chart. And in a downtrend, the previous day low will often serve as a reliable resistance area for the current day, like in this ExxonMobil chart. During a ranging market, you'll often see the price reacting to both levels. Paying attention to these levels will allow us two things. We can easily identify potential breakout areas, but we can also take trades when the market is not moving in a clear defined trend. I prefer to increase my chances of entering in high probability areas, so I always look for confluence on my charts. That's why I add the Bollinger Bands for this setup. I often use the Bollinger Bands with a 50 period moving average and a standard deviation of 3, because almost 99% of the price action is contained within the standard deviation of 3 of the Bollinger Bands. I prefer to trade with the odds in my favor, and if a standard deviation of 3 will offer me 99% certainty that the price won't exceed the Bollinger Bands, then I will be interested to trade only with this setup. Bollinger Bands serve as a pretty accurate dynamic and support and resistance indicator, and the price barely exceeds the bands. In a ranging markets, I want to see the bands narrow and parallel. From my experience, this pattern is quite reliable when there is no clear trend on the market. The price will often touch the lower and the upper Bollinger Bands, and the middle band will also serve as a support and resistance. In a trending market, the price will often stay between the middle line and the upper or the lower Bollinger Band. In this example, we have a clear downtrend, and the price stood most of the time between the middle line and the lower Bollinger Band. So, how do we combine the previous day high and low with a Bollinger Band? Very simple. We search for confluence areas between them, and we trade when the price action is near, or ideally touches the confluence area. The most reliable signals appear when the market is in a range. Here is an area of confluence between the previous day low and the lower Bollinger Band. The price was trading in a range in a weak uptrend, if we take into account the higher highs and the lower lows. The signal appeared when the price touched the previous low and the lower Bollinger Band. In addition, we have the previous resistance became support after the breakout. So we had three major forces around that area. This was a high probability buy signal with a stop loss below the confluence area. Regarding the take profit zones, there are a couple of alternatives. You could aim for a 2-to-1 risk-reward ratio, or you can target the upper Bollinger Band. The third choice would be a break-even stop once in profit for a risk-free trade. If you choose the third option with a break-even stop, be prepared to be stopped out often from your trades, but once you will catch a good trend, this will make up for all your break-even trades and more. Here is a short trade. In this chart we have a clear range with no trend whatsoever. And here is the confluence area between the previous high and the upper Bollinger Band. Once the price touched the confluence area, the sellers immediately gained control of the market and pushed the prices down. There are two types of entries here. An aggressive entry, when the price touches the Bollinger Band and the previous high, which is what I prefer. Or a conservative entry, after you'll get some sort of confirmation of rejection from that area. In this case, you wait until the red candle rejects the confluence zone. Let's take another example, and by now I hope you comprehended how the signals work. Here's a quick exercise. Can you determine the best entry on this chart? You have 5 seconds. Here it is, the low of the previous day, the lower Bollinger Band, and the clear rejection of that area. The wick of the rejection candle confirmed that the buyers entered the market and pushed the prices to the upper side of the Bollinger Band. The same setup on another chart. We have a range within a weak uptrend after higher highs and equal lows. The price touched twice the previous day low, forming wicks on the rejection candles. The price took off and reached the previous day high in the upper Bollinger Band. Now, there is another type of signal which is riskier in my opinion, and it appears when the market is trending. If in the previous examples we were taking signals inside the range of the previous high and low, between the two extremes of the previous day, this time we search for entries when you have a breakout of one of these levels. So, in this example, we have a clear downtrend, the price recording lower lows and lower highs. Here, the price broke the previous day low, so the alternative of trading inside the range was gone. Once the price returned to the breakout level, at the low of the previous day, we had an opportunity to short the market because the middle Bollinger Band acted as a dynamic area of resistance. As you can see, the price formed another downward swing before it finally reversed. Let's take another example. Here is a perfect buy right to the pip. We have a clear upward trend with higher highs and higher lows. The price broke the previous high of the day and retraced to the breakout level. The middle Bollinger Band offered support, and the price immediately rejected the confluence area, also confirmed by the reversal candlestick which formed right after the buyers entered the market. If we look back in the chart, we can spot another buy entry here, this time not as obvious as the previous one. The price broke the previous high and consolidated here before it finally took off, recording new highs. And here is a short trade. We have a clear downward trend with lower lows and lower highs, and the price broke the previous low of the day and retraced to the breakout level. The middle Bollinger Band offered resistance, and the price continued its downward direction after testing the confluence area. As you can observe from these examples, the high and lows of the previous day are without doubt one of the most important levels you must have on your charts. If a market cannot go any lower, it means that some sort of buying pressure must have come in at those levels to support the market. This is why you have to know about these levels not after the event, but before and in good time to be able to monitor the situation and react according to the price action you see unfolding in front of you. Now, if you learned something new or found value, please consider subscribing to our channel, share and like this video, as it would help us a lot in the future. Until next time.